Francisco, you've been dealing with these kinds of markets for years now and the volatility. Can you take us through what's been surprising, if anything, about the copper and cocoa moves over the course of the last couple of months?
Sure, Dom. So I think, first of all, if you look at the commodity complex broadly since the beginning of the year, indices such as the BCOM are up around 7% year to date. So clearly, we've seen, following the meltdown in oil prices at the end of December, with the OPEC meeting going wrong, we've seen the commodity complex really pushing higher. And now the macro data is looking more positive generally. We're seeing better data coming out of Europe, better macro data coming out of China. And obviously, we've seen better inflation prints in the U.S. So now I think people are starting to get more constructive, generally, investors more constructive on the outlook for the complex. Obviously, copper is the biggest choke point across the major commodities because the supply side is very challenged, and we have demand growth rates potentially averaging 4% on a forward basis. So it's going to be really hard to meet those expected demand growth rates. And cocoa is a bit of a different story. It's also supply driven, also a long cycle commodity. But I would broadly separate the complex between the commodities that have a very challenging supply side, basically low price elasticity of supply, and those commodities that are relatively easy to fix, where we can bring volumes back to meet incremental consumption quickly.
There's also this idea of the disjoint. I mean, not disjoint. There's a building spread between where copper is trading here in the U.S. and where it's trading globally. You've laid out some of the fundamental reasons why copper could be subject to some of these price action and the movements there. What's driving the difference between where LME metals are trading, copper specifically, and what's happening here in the U.S. and domestic shores?
Well, a lot of it has to do with inventories on different parts of the Atlantic. Remember that at the end of the day, this futures exchanges have inventories backing them out, and we've also imposed restrictions on metal that originates from places like Russia on sanctions. So there is challenges like that. For instance, like, how are you going to fix it? I think is by moving more material from Europe and from other parts of the world into the U.S. And I think the physical trading houses will do that. But it is a very unusual move, to your point, that we have a 10% differential between the U.S. price and the London price. And like I said, physically that will be fixed, because at the end of the day, all it takes is a vessel and a few weeks on the high seas to get the copper there. But also it's going to pull up. It's already pulling up the prices in Europe, right? So we've seen the short squeeze in North America, and now we're getting the uplift in other markets. That's been the price action in recent days. And we are concerned about exponential moves or non-linear moves in copper. We have a $12,000 target for next 18 months, and we think that, well, things are happening maybe a little faster than we expected here.